Preparing for a financial analysis at Kellogg's interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does a financial analyst do at a consumer packaged goods company like Kellogg's? I see financial analysis as turning operating data into decisions. At Kellogg's, that could mean explaining volume, price, mix, commodity costs, advertising, and working capital, then translating them into a forecast. I would partner with brand, supply chain, and sales teams, challenge assumptions constructively, and communicate risks clearly. My objective would be a reliable outlook that supports profitable growth, not simply a spreadsheet that reconciles. While answering, focus on converting operating data into decisions, partnering with commercial and supply chain teams, challenging assumptions, forecasting performance, explaining variances, and communicating risks clearly to management. Question 2. Walk me through how the three financial statements connect. First, I would start with net sales, subtract cost of goods sold to derive gross profit, then deduct operating expenses, depreciation, interest, and taxes to reach net income. Net income feeds retained earnings, while adding back non-cash items and adjusting for working capital connects earnings to operating cash flow. Investing and financing cash flows explain capital spending, debt, dividends, and share activity. I use all three statements together to test forecast consistency. Make sure to cover how revenue and expenses create net income, how net income flows into retained earnings, how non-cash items and working capital reconcile to operating cash flow, and how investing and financing activities affect cash. Question 3. How would you build a revenue forecast for Kellogg's? To build a revenue forecast, I would separate volume, price, mix, distribution, and foreign exchange effects. For Kellogg's, I might forecast units by brand and channel, apply planned pricing, and validate assumptions against retailer trends and market share data. I would create base, upside, and downside cases, then reconcile the result to historical seasonality and management strategic plans. This makes the forecast explainable, measurable, and easy to update when actual sales arrive. In your answer, talk about separating volume, price, mix, distribution, foreign exchange, brands, channels, seasonality, market share, retailer trends, and base, upside, and downside scenarios. Question 4. How would you analyze a change in gross margin? Gross margin is net sales less cost of goods sold divided by net sales. I would analyze Kellogg's margin through price realization, volume, product mix, input costs, manufacturing efficiency, freight, and currency. A favorable price increase may be offset by lower volumes or trade spending, so I would build a bridge rather than rely on one percentage. I would also distinguish temporary commodity relief from structural productivity because that improves forecasting and valuation. Be sure to mention price realization, volume, product mix, trade spending, ingredients, packaging, freight, currency, productivity, and distinguishing temporary commodity benefits from sustainable operational improvement. Question 5. Suppose actual results miss your forecast. How would you investigate the variance? If actual results miss forecast, I would quantify the variance by revenue, gross margin, operating expense, and timing drivers before assigning blame. For example, a sales shortfall could reflect retailer destocking, not weak consumer demand, while margin pressure could come from commodities or mix. I would validate data with commercial and supply chain partners, update the forecast, document root causes, and recommend actions. That creates a learning loop rather than merely explaining an unfavorable variance. Focus on decomposing the miss into revenue, margin, expense, and timing drivers, validating the data with business partners, identifying root causes, updating assumptions, and recommending corrective actions. Question 6. What is the difference between a budget and a rolling forecast? An annual budget sets an approved financial plan, whereas a rolling forecast continually updates expectations using the latest information. I would use the budget to align spending, headcount, pricing, and investment with strategy, then refresh the forecast monthly or quarterly as actuals change. At Kellogg's, I would keep assumptions transparent by separating volume, price, mix, commodities, and discretionary spending. The budget establishes accountability. The rolling forecast improves decision speed. Make sure to cover the budget as an approved strategic plan, the rolling forecast as an updated outlook, their different purposes, transparent operating assumptions, accountability, and faster decision-making. Question 7. Which working capital metrics would you monitor and why? Working capital measures resources tied up in receivables, inventory, and payables. At a packaged foods company, I would monitor inventory days, receivable days, payable days, obsolete stock, and the cash conversion cycle. These metrics reveal whether cash is being consumed by excess production, slow collections, or weak supplier terms. I would investigate operational causes before recommending production changes, collection focus, or payment renegotiation, while considering service levels, retailer relationships, and cash flow effects. Discuss inventory days, receivable days, payable days, obsolete stock, cash conversion cycle, retailer service levels, collections, supplier terms, and the operational causes behind movements in cash usage. Question 8. How would rising commodity costs affect your financial model? Commodity volatility matters because ingredients, packaging, freight, and energy can materially change cost of goods sold. I would model each major input separately, use market indicators and procurement information, and distinguish contracted prices from exposed volumes. Then I would run sensitivities showing gross margin and earnings effects, along with mitigation through reformulation, sourcing, productivity, or consumer pricing. At Kellogg's, I would explain timing carefully because a price increase may lag cost inflation. In your answer, address ingredients, packaging, freight, energy, procurement contracts, exposed volumes, market indicators, pricing, reformulation, sourcing, productivity, and the timing of margin recovery. Question 9. How would you evaluate the financial return on a marketing campaign? Marketing spending is not automatically a cost to minimize. It can protect brand equity and support future volume. I would evaluate campaigns using incremental sales, gross profit, market share, return on investment, and time lags. I would compare base and promoted performance, control for pricing and distribution, and avoid claiming causation from correlation alone. If a campaign strengthens a strategic brand, I would present both near-term margin impact and longer-term economic value. Focus on incremental sales and gross profit, return on investment, market share, promotion effects, time lags, brand equity, appropriate controls, and separating correlation from true marketing causation. Question 10. Which Excel tools would you use to analyze Kellogg's sales and profitability? In Excel, I use clean inputs, separate assumptions from formulas, and build checks that flag errors. I am comfortable with XLOOKUP or index match, SUMIFs, pivot tables, conditional formatting, and sensitivity tables. For a Kellogg sales model, I might map SKU and channel data, calculate volume and price bridges, and reconcile totals to the general ledger. I would keep the workbook auditable, document sources, and explain outputs without hiding behind formulas. Be sure to mention structured inputs, auditable formulas, XLOOKUP or index match, SUMIFs, pivot tables, sensitivity analysis, reconciliations, documentation, and communicating conclusions without relying on opaque workbooks. Question 11. How would you assess accruals for promotions, rebates, and bonuses? Accrual accounting records economic activity when earned or incurred, rather than only when cash moves. I would review sales cutoff, promotional allowances, rebates, bonuses, freight, and supplier invoices to ensure the period reflects reality. For example, if a retailer earns a promotion allowance before payment, Kellogg's may need an estimate and later true up. I would support estimates with contracts, historical experience, and subsequent settlements, then assess materiality and control evidence. Talk about accrual accounting, sales cutoff, promotional allowances, rebates, bonuses, freight, contracts, historical experience, subsequent settlements, true-ups, materiality, and control evidence. Question 12. How would you reconcile net income to operating cash flow? Operating cash flow shows cash generated by core operations after working capital movements, while net income includes non-cash and timing effects. I would reconcile earnings by adding back depreciation and other non-cash charges, then adjusting for receivables, inventory, payables, and accruals. I would separately assess capital expenditures, acquisitions, debt, and dividends in investing and financing cash flow. This helps determine whether reported profit converts into liquidity and whether growth is cash-intensive. Explain non-cash charges, working capital movements, receivables, inventory, payables, accruals, capital expenditures, acquisitions, debt, dividends, liquidity, and why profitable growth may still consume cash. Question 13. How would you build a downside scenario for Kellogg's? For downside case, I would change the assumptions that actually drive risk: volume, price realization, mix, commodity costs, foreign exchange, and retailer inventory. I would avoid simply reducing every line by the same percentage. Instead, I would model operational responses such as lower production, reduced advertising, or delayed capital spending while identifying fixed costs that remain. I would quantify earnings, cash flow, covenant, and liquidity effects, then recommend trigger points for management. Focus on changing genuine risk drivers such as volume, price, mix, commodities, currency, and retailer inventory. Model operational responses, identify fixed costs, and define management trigger points. Question 14. Tell me about a time you disagreed with a business partner's forecast. When a sales leader challenges my forecast, I would first clarify the assumption and evidence rather than defend my spreadsheet. I might compare retailer data, shipment trends, and historical bias, then present a range instead of false precision. If disagreement remains, I would document both views, ask the appropriate manager to decide, and update the model transparently. That approach protects relationships while preserving analytical independence when forecasts influence spending and inventory decisions. Make sure to cover listening first, clarifying assumptions, using evidence, presenting ranges, preserving relationships, escalating appropriately, documenting different views, and maintaining analytical independence. Question 15. Why do you want to join Kellogg's as a financial analyst? I am interested in Kellogg's because its brands operate at the intersection of consumer behavior, pricing, supply chains, and disciplined capital allocation. A financial analyst can influence decisions well beyond reporting by identifying profitable growth, challenging assumptions, and translating volatility into actions. I would bring strong accounting fundamentals, advanced Excel skills, curiosity about commercial drivers, and clear communication. I also value the company's evolving portfolio and would be motivated to learn from cross-functional partners while delivering dependable analysis. In your answer, connect Kellogg's brands with consumer behavior, pricing, supply chains, and capital allocation, explain your analytical strengths, and show enthusiasm for cross-functional, commercially relevant work. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.